We can test it out. What a lot of professors done is oh, they use the AirPods, but I don't think you can connect it to the computer.
They use the AirPods?
Their own AirPods. But,
yeah, I have them.
I don't think you can connect it to your computer because my previous professor he uses his own MacBook for Zoom, so he uses AirPods to connect that, and then it's very clear because the AirPods are right to you. So maybe we can.
Let's see if we can.
Maybe you can mute that, but unmute your the Zoom on your laptop.
Okay, hold on a second. Let me. So in the meantime, are you able to connect, even though? I mean, you're sitting over there. It's all right. Now I'm just trying to get. Well, I don't think we need a projection of the classroom. All right. So. All right, let me let people in.
You guys.
Yeah, here you go. And so you want me to unmute my laptop?
Maybe that's the way. If you can like mute the actual computer and unmute your laptop, then connect your AirPods to your laptop. Maybe that's the.
But hold on a second. Devices. Okay. Well, let me see if they can hear me. Can you guys hear me okay? Okay. So that's good. Yeah, we were trying a new trick to see if I needed to use my AirPods, but if you guys can hear me, I suppose we are okay. Good afternoon. Oh, I have people. Yeah. All right. Welcome back after the long weekend. I hope you guys had a nice long weekend. We're gonna get started real quick. Just one quick reminder. Please let me know if you have any questions as far as homework. And the other reminder is office hours are tomorrow 2 to 4. So you have your Zoom link on Questrom Tools for office hours. Let me know if you have any questions, if you have any concern, or like what have you through office hours. All right, so we are going to get started. Just as an FYI, I have posted the slides of class without the answer keys into Questrom Tools, and then at the end of class, you will find the answer keys, and also you will find the recordings of the classes. Typically, I try to post the recordings right away. I mean, the right away means, unfortunately, it takes a moment because there's a queue to download the information into Questrom Tools. So bear with me on that. The other thing that I wanted to tell you is that I will be posting, so I post classes, like the slides for each class, and then at the end, I post the slides of the whole chapter. Over the years, what I found is that, the slides for each class kind of helps you to review the material before class, just to get a sense of like, what are we talking about? Whereas like the classes, the slides of the whole chapter are very useful when you're doing your review, when you're studying for the homework and all that. Because of that, in the slides of the whole chapter, what I do is I typically add more information. Just because like I've seen students either printed them or like literally highlighting them or putting notes, just because it helps them to be a good complement to the book. So don't be surprised if you find more examples of financial statements or more slides into the chapter, into the whole chapter slide deck, that's because that's done on purpose. So you have more material to refer to when you're doing review. And again, typically is not crucial material because we go through the main important elements of what we have to do during class time. It's more review for you. Anyhow, having said that, any questions? All right, so I am going to start class first and foremost though. Hold on, I have to show my clearance for the day, just so we're all, okay, hold on 1 second. I have to show the clearance that I am, I'm cleared for 9/9/20. Thank you. All right, so, and we can go from there. All right. All right, so today, the idea is that we're gonna wrap up the chapter. I'm sorry, I'm about to lose my voice because I've been told that it's very difficult to hear and I keep screaming. But if you feel a tone of voice is too much to handle, please let me know. Tell me, Rosalba, you can, you can go down with your tone of voice because we can hear you fine. But typically, I have been in situations the opposite where I'm the student and I realize that it's very difficult to hear from the microphones. Anyhow, all right, so any point of time, if you think that I'm at the point that I'm almost yelling, please say you don't need to yell. I don't take it personal. I mean, I know it's, we're all trying to learn here. So, all right, so we are going to be talking about wrapping up financial statements, and we're really going to be focusing on the financial statements and how financial statements relate to one another. So we're going to try to make the connections there. And for folks that are not on camera, please make sure that you are on camera with your camera on, so we can create a sense of community. All right, so you may recall this. We talked about, I'm just going to minimize the ribbon. We talked about the 4 sets of financial statements. And the first one that we talked about was the balance sheet. And do you guys remember why I have one person on the left-hand side and 2 people on the right-hand side of the balance sheet picture? Anybody remembers what is that? Has nothing to do with the weight of these people, as much as that seemed to be, might look intuitive of what that is. Brooke, let me, hold on.
Can you hear me?
Yes, I can.
I would say that it's for equity versus assets and liabilities.
Okay, and so basically, yes, the 3 people represents one element, each of them represents an element of the financial statement. So we're gonna have the assets. Oh, this pen doesn't work very well. I almost feel like I've tried this before. Never mind. Hold on 1 second. We have an issue with the pen. No, it's not.
Yeah, I think those are very reliable. Depends.
I don't know. They should be reliable though. Anyhow, so we have the person on the left-hand side. So Brooke said it right. I mean, the 3 people represent the elements of the financial statement. The one on the left is the asset, which equals liabilities plus equity. And we're going to talk about that in a moment. Then we're going to talk about the income statement. We're going to talk about cash flow and statement of retained earnings. Even though we have other comprehensive income, We're not gonna talk about other comprehensive income as scope of this class. So, yes,
How do you determine assets though? Because like, what if I am McDonald and I say like, the song, like makes me $100 million last quarter because when people hear that song,
yeah.
they want to buy McDonald's more. So how do you determine those kind of things?
Yeah, but that's a great question. That wouldn't be, that's my, my brand name, but the assets in this case are referred to as the resources that I use to, to create value for the company in the future. Now, the ad, it's not an asset per se, it's an expense, because we're gonna see later in the semester how we define the asset. We book them as in the balance sheet as assets. We book all the items that then can have a future benefit. With the ad, it's very difficult to find a future benefit and measure that. So I'm gonna give you another example. Yeah, you hear the song, you go right away to buy the burger from McDonald's.
Yeah.
I, on the other hand, because I have two children that if they're given the possibility, they probably go to McDonald's every second. What I do, I'm like, nope, we're not going. And then maybe 2 months from now, I'm like, you know what, let's go. Because I'm playing that song in the back of my mind. But from an accounting standpoint and by financial statements, I cannot match the time where I play the ad and the time where I'm gonna get money out, like revenue, sales out of that ad. So that ad cost is expense right away. Conversely, on the other hand, the meat. Okay, so the meat is my inventory, and it's an asset. It's a resource to which I can attach, like, when is it gonna get sold? I can easily see it. I mean, like, as I use it and I sell it. So that meat is first an inventory, which will be a resource that will give me future benefit. Say I freeze that meat, as I then start using that meat, and it will become an expense, and it will be used for me to make sales. So in that sense, it's very easy to identify the resource. For the ad, we don't talk about assets just because in the definition of the assets are resources that can be used for future benefits. Whereas with the ad, you're not able to see, am I gonna have a future benefit or not? You're not gonna go person by person and say, hey, do you buy the burgers because you hear the song? Do you buy the burger because you hear the song? So you're not able to measure how much is the benefit.
What about contracts then? So like, let's say that I have like, I'm a company and then my earnings report is like due like next week. And I'm gonna talk with another company with a contract with a certain amount. Do I put that in there?
What do you mean by, so the question is, what about contracts used as an asset?
Yeah, so if I'm a company and I'm talking with Amazon for like a contract with like a certain amount of money, and I have to report my balance sheet basically, my income statement. Do I put that in the income statement? Because I myself am confident that the deal will go through, even though the deal hasn't gone through yet.
No. Yeah. No, because in the balance sheet, you will put only economic events that happened. So you wouldn't, and first of all, and second, if you have a contract with Amazon, say you sell t-shirts, and you sign up a contract with Amazon, and then you're gonna sell the t-shirts through Amazon, your asset will still be the t-shirts. The contract with Amazon will give you a value, will increase your sales. So we'll see towards the semester. I mean, assets are the inventory, money that you have to get from creditors, like from your clients, accounts receivable, will be again like long-term assets, the equipment, the furniture that you see here. Those are assets. Why all the above create a future value? Well, unless I have I have desks, even though this semester is kind of outlier, unless I have desks, I cannot run a business of education. And so those desks, the cost associated with purchasing those desks will be the one that will allow me to give future benefits to my students and to my business. So yeah, we'll definitely talk more about it. But no, if you have signed a contract and you didn't make any sale, there's nothing you can book into the financial statements. All right, you can make a note and say, by the way, I signed up this contract with Amazon, but it would be disclosed in your footnotes. There won't be any numerical value into the financial statements. That's a great question. So balance sheet, assets equal liabilities plus equity. Then here we have the income statement, which is really the little girl telling the story. And then because the income statement tells us, remember the poll that we had done last class, how is the company performing? Then we have the statement of cash flow that tells us how did the cash change over time, and then the statement of return earnings that tells us how the value that I create of the company, like based on like what my own resources, how the equity that I create internally has changed over time. So balance sheet, remember this slide, we projected it last class, but I'm gonna bring it back for you just because we are at the beginning of a week and we had a long weekend. So we have a balance sheet at, I'm gonna try this again with the notation. Here you go. We have a balance sheet at point A, okay? And so I wanna know balance sheet at point B. Remember, balance sheet is a point of time, on time information. How much cash I have today, $10 billion. It doesn't tell me, did it change from yesterday? It tells me just how much cash I have today. I might know that yesterday, or like, let's make it a month ago, cash was $5 million, but the balance sheet will just tell me, today you have $10 million. It won't tell me how that changed. How that changed, it will be given by the cash flow statement, which measures the change over time. How did the company grow internally in terms of like how much equity, how much worth the company was able to produce internally, performing over time? That will be the story told by the income statement. And this is not working again. I gotta talk to IT, I apologize, guys. Here you go. So that will be the income statement. Lastly, if I wanna know how much my equity is being generated by my own resources, like by my own profit, that will be in the changes of retained earnings. So keep that in mind. So these three elements that cash flow, income statement, and retained earnings tell me over time, like over a period of time, how things have changed to bring balance sheet from point A to point B. So balance sheet gives me the information at a single point of time. So assets are what you own, what is mine, my inventory. The accounts receivable are mine because eventually somebody's gonna pay me. My assets, the furniture and fixture are mine. My investments are mine in other stocks of other companies. Minus the liabilities, what I owe others, it gives me how much the company is worth. So if I have assets that are my resources to run my business of $10 million, and I have liability for 3, then my company is worth 7 because of all my resources. Once I pay back all my liability, I'll be left with $7 million. So if assets equal minus liability equal equity, then assets equal liability plus equity. And again, we said that before. This equation, guys, it's really what you need to learn and understand, which is like for each and every resource, I have a claim against that resource, which is my liabilities, comes from liabilities or equity at any single point of time. Then we are done. So assets is the person on the left and liability plus equity are the two people on the right. Then we made the little example here of Apple Cart LLC, which I have printed for convenience. We're gonna do it real quick using the document, just because it's easier, and I hope you guys can see this. Here. So here I am, and we're gonna demonstrate that assets equal liabilities plus equity at any point of time. So here I have my assets equals liabilities plus equity, okay? So number one, we put $100 of our own money into the company. So I have cash over here, which is an account of the assets, and in the equity, I'm gonna use paid-in capital, which is an account of the equity. So I put in $100, and I have now $100 in equity. Just making sure. Here you go. So here, my assets equal my liabilities plus equity, because my assets are 100 right here, and my liabilities plus equity are 100. So this is my first transaction. My second transaction, AC LLC borrows 200 from a bank. So my cash will go up by 200, my liabilities will go up by 200, and so even in this case, my assets equal my liabilities plus equity. So again, this is true, the equation assets equal liabilities plus equity is true at the transaction level, but also overall. In fact, if I want to draw a line over here, I'll have a $300 cash equal $300 of liabilities and equity. So my assets equal my liability plus equity. All right? And again, you can draw the line at any point of time, is always going to work. Now, let me do the third transaction. The third transaction says that the company, here, there's a pay missing, pays $275 to buy a cart. So I'm gonna need another account, which is cart, $275. What happens? How do I balance? How do I make sure that asset still equals liability plus equity? What do I need to do? Remember, accounting is easier than you think. If the company pays $275 to buy a cart, in English, if you had to say it to your friend that is a philosophy major and is telling you what's happening here, LLC will have a cart, but what happened?
The cash goes down.
The cash will go down. So, and again, you go and buy a t-shirt, you'll have the t-shirt, but you won't have money in your wallet. So assets still equal liability plus equity here. Why? Because in here, this is a zero-sum transaction, and here you had no transaction whatsoever. So your assets equal your liability plus equity. All right? So that's pretty much where we are at. All right, and in fact, I mean, this could be represented similarly as, you know, you can have it like this, or you can have it the way I showed it. Most of the times, I mean, it's more like that you have the accounts one next to the other as opposed to one below the other. But yeah, that's pretty much the situation. Now, assets again are economic resources of a business that are expected to benefit future operations. Liabilities are obligations that can be monetary or non-monetary. Stockholders' equity, on the other hand, is a claim of the owners after creditors, like a claim of the owners on the company. So the paid-in capital is the amount invested, so the claim of the owner is the ownership. And from the retained earnings, the claim of the owner will be the dividends to be distributed over time. All right, so again, assets are what we own, and liabilities and equity are what we paid for it, how we paid for it. So assets are stuff that we purchase versus equity are investments, and liabilities are what we borrow at a specific point in time. So let's keep that in mind. It's always at a specific point in time. Questions before we move on? Yes.
I was asking questions. If I mortgage a house, what do you put there?
If you have a mortgage for a house,
If I have a company and I mortgage a
if you mortgage a property,
yeah.
you put the asset. I'll make it simple because there could be very different financial ways of doing it. I mean, you could have a capital lease, but we'll make the most simple option here. You put, like, say you'll have the asset, and in the liability, you'll have the mortgage obligation, which will equal. Yeah. All right. All right, again, I want to draw your attention again to this graphical representation, because an element that we're going to be focusing on now is the income statement, which is one of the statements that allows you to go from balance sheet at point A to balance sheet at point B. The income statement tells a story for a certain period of time. See the little girl with the doodle. It's revenue minus, which is what you sold, minus expenses, which is what it costed you to run the company, equals net income, which is the most important fund, what is left over a certain period of time. You're not interested in how much is my net income at a specific point of time. Because your net income today might be zero just because you didn't make sales, but that doesn't mean that you're not profitable. You want to know over a period of time, over the accounting period, how did the company perform? So see how it's different from the balance sheet? This is telling you a story. Now, some people confuse, especially at this stage, revenue with net income. When I say, how is the company performing, you guys tell me, well, that's revenue. Well, it's a component. You're actually looking at the net income, because I could have beautiful revenue. I could have $10 billion of revenue, but what if I have $11 billion of expenses? So really, what you want to see in order to understand if the company is performing is, of all the sales that I made, have I been able to manage the expenses associated with those sales so that I have a profit? So here we have the little girl with her cart, and we're going to try to figure out, if this is a profitable business. So I am, again, going to share the document camera. And so I want to build an income statement. Here you go, where I have revenue minus expenses equal net income. So now let's attach dollars here. How much is my revenue? So
60.
Go ahead.
60.
So yes, it's 60 because I buy a crate of apples for $40, ran an ad for $5, it works. We sell apples for $60. Minus, how much are my expenses?
45.
45. So my net income is 15. The 45 is 40. My cost of goods sold, which we'll talk extensively about, much better. And $5 is my advertising cost. All right? Notice I have both of them consolidated over here. And we'll see in a moment that that could be problematic because I pretty much don't have a sense of what is driving the profit in terms of costs. So yes, that's my net income. So revenue are like the exchange of goods or services to a customer. And remember, you cannot book the revenue until you actually have provided the service or exchanged the goods. So you couldn't book the revenue because on average, you sell $60 worth of Apple every day. Unless you actually sold that day the $60 worth of Apple, you cannot book the revenue because you'll be commingling budgets and actuals. Expenses are the cost of doing business. I would like to draw your attention to this definition. Assets, if I can only highlight it, with our assets and resources, I can highlight it, never mind. This is so frustrating. Okay, assets and resources used to provide those revenue. I mean, please, 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 guys, try to sort of remember this definition and try to think about it for a moment. I am using assets and resources, and as I use them, they become expenses. My inventory, my apples, as I use them, they become expenses of running the business. First, they were an inventory, a resource. And then they become an expense because they are the cost of running the business. This is a very important concept that we're going to go back to over time and think about how the assets, sometimes it's called that they expired or they are used into the business, and as we use them, they become expenses. Because if assets are, think about depreciation. If I buy desks for this classroom, those are my assets. As I use them, I can depreciate them over time to sort of measure how those desks have benefited my activity, and I book them as depreciation expense. Whereas the net income are revenue less expenses associated with getting those revenue. So that's easy. However, so typically what we do, we use intermediate measures for income statement, just to sort of have a sense of what is that is driving the profit. So we have sales or revenue, which is the top line, minus the cost of sales, which is the cost of goods provided to the customers. That gives me the gross profit. The gross profit really tells me how from my core business, how much profit do I make? From selling the apples, I make $20. And that's important. You don't want a gross profit to be negative because it means that you pay more to get the items that you're selling than your sale price. So you need to adjust your sales price because it's probably too low. Or you need to change where you get your raw materials from to get your cost of goods sold lower. Minus operating expenses, it could be the ad, it gives me the operating income of earning before interest and taxes. So this second sort of measure helps me to figure out, okay, I have a gross profit that is positive, but if I have an operating income that is negative, I might be spending too much in operating expenses. Say, I was making this example, which is absurd, but just to give you a sense, I was making this example this morning. Say I have Apple Cart LLC is a chain of little carts of fruit and vegetables around the city. You're in New York City, you have 50 of those, but the CEO is a lavish spender and is like, you know what? I have 50 carts of fruits and vegetables. I want the corporate office in Park Avenue. there's no need for it. You still can be profitable by selling your apples and getting a margin of $20 per batch of sales, but then your operating expenses will sink down your income because your CEO is crazy and wants the corporate office in Park Avenue, where the rents are sky high. But knowing where is the issue in terms of losses, you can control it. And the income statement will be useful for you to make decisions. You can tell the guy as a board, you don't get the office in Park Avenue. If you want, you buy your own house over there. You get the office someplace else. Maybe outside of New York City, where the rent is lower. Again, in normal circumstances. With all else equal and controlling for the pandemic. All right. Then again, interest expenses and taxes can also drive down the bottom line. But again, what we are interested in is the bottom line. And we control how the bottom line changes. I'm going to try one more time. By looking at those intermediate measures of gross profit, operating income, and net income. That's why the model of consolidating all the expenses in one line item, like we've done for the example of Apple Cart LLC, is not going to work because you cannot understand what drives you what. So this is Apple, another Apple. And notice I have a gross margin. Well, let's look at a summarized results. I have a gross profit of 101, and I have a net income of 59. In percentage of revenue, the gross profit is 38%. Never mind. I'll talk with IT. I love annotating on the thing over here, by the way. And whereas the net income is 22%. Why? Because you have operating expenses of 30 billion over there. Is it reasonable? Yes, no, maybe so. Somebody should look into it to get that information, to make that evaluation and determination. Think about it. Apple has a huge chunk, half of his operating expenses are research and development. Going back to your example, research and development, you can say, well, that's an asset because it creates value in the future, but it's the same thing. I don't know. Research and development can create a value today or not, unless I then market the product. What if the iPhone, what's the new one? The 12? The 12?
Yeah, it's coming out September 15th, so next 6 days.
Oh, so I'm eligible for the 12. So let's say you did, but they've done research and development for the whole year, if not more, and they had a bunch of costs for it, but you didn't know if there was going to be an iPhone 12 coming out. So the conservatism rule tells you put everything as an expense, you don't book it as an asset. And then when you get the iPhone 12, all the iPhone 12s will be your inventory, and as you use them, as you sell them, they'll become your cost of goods sold. So rightfully so, Apple has a lot of research and development, and then selling and general administrative expenses over here. So that's my income statement. It tells me the story of how I made my profit. I have a good gross margin here. I have an operating income, which is still 27%, and net income of 22%. This is September 2018. I can probably imagine that the percentages, the margins are higher because Apple is making money there's no tomorrow at this time. So anyhow, we've done balance sheet, income statement. Again, we're not going to check on other comprehensive income. Let's look at statement of cash flow. It's nice to define it, family relations among the financial statements, but the statement of cash flow is seen as the cousin of the income statement because it tells me a story, but in another way. So let's just clear up something over here. The fact that I made $265 billion in sales doesn't mean that I cashed $265 billion. It doesn't mean that everybody paid me. I can sell 100 phones, 100, like iPhone 12s as September 15 comes to a company. I delivered the phones and then with an invoice, I made the sale, I can book the revenue, but I don't have the cash because the company will need to, send me a wire transfer with that cash. That can happen later on. It can happen in October when the bill is due. So the story that the cash flow tells you is, regardless of your revenue, how much cash do you make? Remember, I can have the most high quality revenue, but if I don't collect them, I'm still gonna go bankrupt. And that's why you wanna know about the cash flow, because you don't wanna get to the point of like, oops, I'm not collecting any of those. So again, it's inflows and outflows over a certain period of time. And to be a little bit more it's an inflow from sales, from revenue, and outflow for cost of production. But in the delta between the two in this silos tells me how much is the change in cash. To be more specific, say you have an increase of cash of $10 million from the beginning of the year. You'll be like, oh, I'm actually collecting more from my revenue. No, you didn't. You sold a big property. So in order to understand where the increase comes from, cash flow tells you the story, but it does it in a beautiful way, which is sort of splitting it between how much cash you got from your core business for your operating activities, how much cash you got from your investing activities, meaning investing in new assets, investing in stocks, or disinvesting, selling those. How much cash you got from financing activities, which is from raising capital and pay back debts or pay dividends. In that way, you are able to get a sense of like, how did I make or lost my cash and for what reason? Now, let me ask you a question. If you had to think about which between operating, investing, and financing you certainly wanted to have as an increase of cash, as a positive inflow, which one of the three, between the cash you get from core operations, from investing or financing, which one would you like to have as positive? Anybody? I'll vote for operating. I want to make sure that I make cash out of my core business. I want to make sure that I make cash from selling the phones. All right, so for example, we're gonna go do this together for just to make sure, because we are being cautious, mindful of time here. Those are all the operation of Apple Card. Buy a crate of apples for $40, run the ad for $5, selling apples for $60. Those are all core activities, but run the ad wasn't paid yet. So my cash flow from operating activities would be how much? Would be 15, would be 20, how much would it be? It would be 20, because I'm gonna have a positive cash inflow from the sale of apples and negative, I'm gonna have an outflow from the purchase of apples, and this, it wouldn't do anything to my cash flow because I haven't paid it yet. It's in my balance sheet as a liability, but it didn't turn into a cash outflow. Then remember, and this is like the exercise that we did for the income statement. Then use money to buy a cart. It's an investing activity. I'm buying assets that I can use in the future. I'm making an investment. That's an outflow. And then we put money into the company, and we borrow money from the bank to raise capital. So my cash increased by $45, and 20 was because of operations. I used, then I raised cash from financing activity and I used it for investing activities. I mean, this is typical of a startup company where the financing activity will be pretty positive and pretty big. So again, this is how a cash flow would look like. And the cash flow for operating activities, investing activities, and financing activities, that's where you find them. We're not gonna go item by item because some of those items are very difficult to describe at this point of time. But again, notice in the investing activity, Walt Disney has investment in parks and resorts, which is the biggest line item. Then the financing activity is negative because they have enough cash that they can reduce their borrowings and purchase their common stock, which we'll spend a lot of time explaining why that is. Why do we buy our own common stocks? So lastly, we're gonna talk about, and again, I'm sorry, notice you have, for people that are in the room, it's difficult to see, but you have a bottom line of cash and cash equivalent of 4,610,000, which is not a coincidence that you carried into the balance sheet to be the same amount. So the cash flow explains how you get that $4,610,000, $10 million, right? So then again, statement of equity and retained earnings, that's the last financial statement that we're gonna talk about. It's really easy, it's beginning retained earnings plus net income, less dividends declared. It gives you the ending retained earnings. Already here, you can get a sense that this amount, it connects it to the income statement. So, because unless you have the bottom line of the net income, which comes from the income statement, you're not gonna know your ending retained earnings. So basically, and this is how you build the connection over here. We'll do it graphically. Your beginning balance of retained earnings, plus or minus, again, this is all my income statement over here. You know, I'm stubborn, I'm gonna keep trying. And then I'll talk to IT, but all this is my income statement. So I plug in to the beginning retained earnings, the income statement, subtract the dividend, I get the ending balance of retained earnings, which I can find into the balance sheet. And that's how you start looking at the connection between the four sets of financial statements. So the idea is, this is the consolidated retained earnings. You have the income statement, the cash flow, and the retained earnings statement will all get you from balance sheet at point A to balance sheet at point B. The order of preparation, guys, it's important. I start with the net income, with the income statement, which will give me the net income that I'll plug into the statement of retained earnings. Once I know what's the statement of retained earnings, I know, then I can build a balance sheet because I'm gonna know in the equity how much is my retained earnings. Once I do that, I can build a statement of cash flow because I'm gonna know how much is my cash balance and I can put together a statement of cash flow. So if you wanna do it like, look at Walt Disney, my net income is $9,391,000 as of October 1st, 2016. I plug that into the statement of retained earnings and I get the ending retained earnings. Then I put that ending retained earnings into my balance sheet, and at that point I can tie my assets with liabilities plus claims. If I'm gonna sort of show again the balance sheet over here. Cash, 4,610,000 will tie with the 4,610,000. Here you go. That I have at the bottom line of cash and cash equivalent for the statement of cash flow. So remember, Net income, comes from the income statement. It goes into the retained earnings, so I can cross-reference it with it. I can then use the retained earnings to, to tie the balance sheet equation, assets equal liabilities plus equity, and then from there, I can use the cash to come up with a statement of cash flow, to reconcile the statement of cash flow. Now, I had put together this exercise for you guys. Unfortunately, we ran out of time, but basically this exercise tells you those are the financial statement relation, like the reports. Here are some numbers, and how do I, by plugging in those numbers, those accounts and balances in here, I come up with the 4 sets of financial reports. And, I'm just gonna give you the overview for one quick second. This is how it would look like, and you'll have it in your slides, in the answer key. But basically, you start like accounts receivable, ending balance will go in the balance sheet. Cash, beginning and ending balance, be careful. Balance sheet is a point of time. You're gonna use the ending balance, whereas the beginning balance will be useful for you to reconcile cash and the cash flow. Cost of goods sold will go into the income statement. So once you have the numbers of the income statement over here, then you can plug the net income into the retained earnings, come up with the retained earnings. That will make you tie your assets of 220 with your liability and equity of 220. So this relationship is assets equal liabilities plus equity. And then again, it's like you're pretty much going to be able to tie then the cash ending balance with the ending balance of the cash flow, which will give you then ultimately a net change of $10. So again, you'll see that posted in the slides right after class. And then I'll post the whole chapter with some extra slides for you to look at. All right, any last word of wisdom? Any questions before we depart? No? All right. Well, thank you very much, guys. We'll resume class on Friday. That's not true. Wednesday is today. And have a good rest of the week. Thank you. Bye. Bye, guys.
Thank you.
Thank you.